Hi guys and welcome. On this video we're going to understand the basics of short selling. What exactly is short selling, how it works, the main benefits and risks, and the main alternatives for those of us who don't want to take the risk of short selling. Have you heard of short selling and short sellers? Maybe you have read on the media that they are speculators and manipulators and that they distort the market. This is not entirely true since all players influence the market as well as each other's performance. But what is short selling? How does it happen, and what is the mechanism of it? Is it appropriate for you or not? Are there any alternatives to it? I will answer all of these questions. So, what exactly is short selling? Of course, short selling is not an easy job. Simply put, short selling is the process of selling securities which an investor doesn't own. Sounds strange? The logic behind it is not, though. Short sellers sell something at a high price because they believe that in the future they can buy it back at a lower price, thus making some profit. So, how do you sell something that you don't have? Well, loans. Remember? You actually borrow a security from a person or a company that owns it. Just like in loans, you need to pay interest because you use someone else's stocks. Short sellers pay fees to the owners. What will happen if the price goes up when a short seller sells the stock instead of going down as planned? In such a case, you will have to pay additional money to buy the stock at a higher price than you borrowed it. Therefore, the amount of a profit of a short seller can make is the difference between the two prices, the sale price and the purchase price. Keep in mind that short selling is riskier than the normal way of investing in stocks. If an investor purchases some stocks, all they can lose is the value of the stocks. But when you borrow something and you pay fees and eventually the value of the stocks plummet, you can be a big-time loser. Still can't get the idea? Let me give you an easy-to-understand example. John wants to try short selling. He goes to Adam and wants to borrow from his stocks, which currently trade at $50 apiece. Adam agrees to lend him 1,000 shares at $50. For that, John has to pay a fee because he's using someone else's assets. Now, why does John want so eagerly to short sell? Let's imagine that he's been doing research for 6 months and he's estimated that the mentioned stock will lose its value in the next month. In his trading account, John has 1,000 stocks, each at $50. He sells them and receives $50,000. Part of this money will be kept as collateral, protection against losses. After the sale, there are two possible scenarios. The price of this stock does indeed fall in the next month to $35 per share. John, therefore, buys back all the 1,000 shares and pays for that $35,000. His gross profit is the difference between the prices. $15,000. Gross is not net, He has to pay fees and other costs. 2. The price of the stock could go up to $60 per share. The amount you have to pay for buying these stocks is $60,000, meaning that John has generated $10,000 of losses. The amount of profit or losses in the example are gross. Keep in mind, anyone dealing with buying or selling stocks will have to pay various fees, costs, and commissions along the way. However, one question is still open. How do you sell a stock that you don't possess? You already know the short answer to this question. You have to borrow the stocks from someone who's willing to do so. The process is actually not so difficult. Once an investor agrees to lend you their stocks, they will relocate their shares to your account. But why would anyone agree to do that? It's all about business. If you're trustworthy, an investor will lend you their shares because you will pay them an interest on the loan. The number of short positions is a great indicator for investors. Knowing is essential, and you have to be ready to check out info on stocks and short selling positions every day if you want to make it big. But where can you find this? The simplest way to do it is to use a reliable source of information, Yahoo Finance. Choose a stock and under the Share Statistics section, you can find the following info. The number of shorted shares. It shows the number of shares which were shorted and should be the same as the number on the NASDAQ. Short ratio. We also call this ratio days to cover, and we calculate it by dividing the number of shorted shares by the average trading volume. 3. Short positions related to the float. This indicator is a percentage, and it shows how the number of shorted shares relates to the float. The float is the actual number of stocks which investors can trade. This indicator is very important. If the indicator shows 100%, it means that all the stocks belonging to a company have been sold. 4. Number of shorted shares in the previous month. Now let's discuss a common phenomenon related to short selling. Short squeeze. So what is a short squeeze? Simply put, this is a situation in which a short seller would never want to be. Sometimes, due to various reasons and factors, a stock's price starts rising. As you already know, this is very bad news for short sellers. They, of course, start closing their short positions, hoping to mitigate losses. By doing so, they add up extra pressure, and the price goes ever so higher. This is what we call a short squeeze. Overall, this is one of the main risks associated with short selling. Now, can short sellers manipulate the market? This is a question that has many answers. Yes, no, and a little bit. Of course, many companies' investors claim that short sellers actually manipulate the market so that they can make huge profits. But isn't that the market itself? Anyone is trying to manipulate something so that they can earn more. Didn't Volkswagen, some 2-3 years ago, try to lie to the public about their diesel cars and the emissions they release? They did, and they admitted to doing so. All countries have laws and authorities which determine what is legal and what is illegal. They will be after anyone who violates the rules, whether it's a normal investor, a short seller, or a big player, like Volkswagen. Keep in mind, short selling is for experienced traders. There are two main types of accounts, cash and margin. The former are the accounts where the broker wants the investor to pay for the securities. The latter are accounts in which the broker lends the securities to the borrower. Having said that, if you want to short sell, you need to have a margin account. Cash accounts do not allow their owners to short sell. I'd recommend everyone who wants to become a trader first to open a demo cash account and get to know the basics of day trading. If you're a rookie and jump into the deep waters of short selling, it's possible that you will lose a lot of money, since the potential for that is limitless. Definitely, short selling is for experienced pros who know the ups and downs of this process. Maybe short selling is not the thing for you. Are there any other ways an investor can benefit from the falling prices of a stock? Let's look at some of the alternatives to shorting. 1. Stock futures. Stock futures are future contracts and work in a similar fashion. A future is a contract between a buyer and a seller, in which one of them should buy or sell an asset at a predetermined price at a specific moment in the future. These financial instruments are usually used by experienced traders. Another great alternative is put options. Put options, just like futures, are contracts between a buyer and seller, in which you can sell the shares at a preliminary agreed price at a specified time. This is not obligatory, only if the seller wants to do so. All you need to do is pay a premium. If the price of the stock is below the agreed price on the day the contract expires, you can make a good profit. If it is higher, then you will only lose the premium. The last alternative to short selling is inverse ETFs. These are exchange-traded funds which track a sector index in reverse. If the underlying index goes down, the ETF will go in the opposite direction, up. Here you don't trade on margin. ETFs track whole sectors through the respective index, which means that you cannot trade single stocks. Bottom line, short selling is a great financial tool. I'd recommend it to people who have advanced knowledge of the market as well as experience in trading. This will not only guarantee successful and profitable trading, but also help you mitigate the potential losses, which again are unlimited. If you want to capitalize on falling prices and you don't feel like short selling is your game, you can always try other things, such as inverse ETFs, put options, and futures. That's it for now. On our website, you can find more posts as well as calculators and other financial tools. Do you plan to short sell? We would love to know your thoughts, so feel free to share them with us in the comments below. I hope you enjoyed it, and don't forget to subscribe to our channel on YouTube to get more free financial education videos.